Hello, hello, hello. Kudakwash, can you hear me? Marco, can you hear me? Marco, there's the light. Hello. Hello, you guys, can you hear me? You need to unmute if you want to say something. Marco, you are not muted, so can you hear me?
Yes.
Ah, good, good, good. Right. Right, so what I want you to do, guys, I want you to remove your videos because we want to increase the bandwidth. Kuda, can you hear me? Right, Kuda, remove your video. There's light, how are you? There's light. Can you hear me? Mupiri?
What? You see how you kanonzi kazoom meeting waizi anonzi mupini mupini anonzi how you say how are you doing
Right, just some housekeeping issues. I want every one of you to unmute and respond to me first. There's light and Mupiri, you are muted.
we are participating, say.
Right, so what I want to hear if you can see my slide.
Hello,
Bank
sir. Good
reconciliation
morning.
statement.
Yes, I can see your slide.
Okay, that's fine. So this lecture is being recorded. So I can always share it on the YouTube channel after the lecture, so that for our colleagues who did not manage to join in, they can also benefit. So for the benefit of those who did not participate in the previous lecture, I'm going to go through these notes again. And we are talking about bank reconciliation statements. And we want to know, why do we do bank reconciliations? Under what circumstances do we do bank reconciliations? Right, can you guys mute now? Upawase, can you mute? Right, good. So what happens is that when we are recording our transaction within our company, for instance, let's say we are CBS Private Limited, As a class, we form our company, and then we open a bank account with, say, CBZ Bank. So under normal circumstances, we've got our own records within the company. These records, which are our cash book, and our cash book has got a column of a bank and has got a column of cash. Cash being the actual, the money that we actually have received. Then the bank being money that was deposited in the bank or paid directly to our bank. But during transactions, during the course of the trading period, we record these transactions in our cash book. For example, we can say, let me take for instance, we open an account. If I hope you can see this. So, oh, no, I don't want this one. Just a moment, I'm trying to sort out something here. Right. So for instance, we have got a T account here. This is cash. This is a cash account. So, and then we have a bank account, a T account for bank. So what happens is these two are asset accounts. These two are asset accounts. And if you remember, we said that whenever we've got transactions that are increasing asset accounts, if the asset is increasing, then we debit the account. We debit the account. So the same applies with bank. If bank is increasing, we also debit the account with that transaction. So if cash is decreasing, then we are going to credit. If bank is decreasing, we are going to credit this bank account. So when do we do this like this debit and credit? For instance, if we do a sale, what it means is that we are going to open a sales account and a bank account. That is if we do a sale. So let's take, for instance, we sell, say we've got cash sales. We've got cash sales of $3,000. $3,000. So what is going to happen is that this cash sale is going to affect a sales account, which is it's going to affect a sales account, which I haven't opened yet. So I'm going to open it, which is sales. So the sales account will be affected. And when we say that when income increases, we credit the account. When income increases, we credit the account. So in this case, we are going to credit, right. We are going to credit this account, just a moment. We are going to debit cash because these are cash sales. Sorry. These are so we've got bank, cash, and sales account. So this is the T account for bank, and the T account for cash, and the T account for sales. And we said that we have got $3,000 sales. So we are going to say 3,000 will come this side. And then because it's cash, so we are going to debit the cash account with 3,000. So what happens is that when we can then decide to bank this money, this cash. So if we decide to take this money to the bank, it means we are going to credit 3,000 here and then debit 3,000 here. What this simply says is that we have moved this 3,000 cash to the bank. How to do that is we credit this cash account by 3,000 and then debit this bank account. So in a bank reconciliation, we are only concerned with these transactions. We are only concerned with the cash and the bank transactions. We are not going to be concerned about this one doesn't concern us in the bank reconciliation statement. We are only concerned with what affected the cash and the bank columns of the cash book. So there are two things that happen. We are going to be concentrating on knowing the relationship between the bank and us, their client. So the relationship between the bank and us, their clients, is that of a debtor and a creditor. Is that of a debtor and a creditor. So let me rub off this. Let me erase this. Right. So what we are saying is that the relationship between the bank and its clients is that of a debtor and a creditor. So what happens is that when you open a bank account, immediately you must deposit some money into the bank. So by giving the bank the money, it means that the bank now owes you, thereby they become your debtor. This is why the bank account is always in the debit side if we have got money. In the records that we have in our own cash book, we are saying that the bank is on the debit side because we have got money that is being held at the bank. So when it comes to the way the bank looks at us, the bank looks at us as its creditors, because we deposit money into their account, into that account which is held by that bank. So when we deposit money, we are in a way have loaned the bank our money which is being held in our bank account. So that point must be very clear, that the relationship between the bank and its client is that of a creditor and a debtor. But if we owe the bank either through the application of a loan and we are given a loan, or through the application of an overdraft facility, and then we draw down the overdraft facility, then at that point we owe the bank, and the bank is our creditor. Right? Are we following? Are we following? Am I still audible? Mupini, you are raising your hand.
No, sir, I was trying to unmute. Yes, I'm following.
Okay, that's great. So Just right. So I was saying that the relationship between the bank and that is that of a creditor and a debtor. We must be very clear with that kind of relationship, because if we don't understand these two, we will have a problem. So you find that when we have our bank statement is always on the credit side if we have got money, and it's in the debit side if we owe the bank. If we have overdrawn our account or we have taken a loan, we are likely to have to be owing the bank. So these entries that we do are on different sides, comparing our books in the books and our books in the bank. So that must be very clear. Now, there are so many reasons why we have got the bank balance that is held, because remember, I'm saying that we need the bank account which we are holding in our cash book to match the bank account which is being held at the bank. So in other words, the bank account in our cash book, assuming that we are doing the same thing with the bank, it must be exactly the same. So for now, I would like to ask for contributions, because it's rare to find the bank statement balance being the same as the cash book balance. What could be some of the reasons why we have got these differences? Let me start with Mupini. Mupini, can you hear me?
Yes, sir, I can hear you.
Yes. What are some of the reasons why we have got the difference between the bank statement balance in our cash book and the bank statement balance at the bank?
Sir, I don't even, I'm not sure.
You are not sure? Can Marco assist?
I'm not sure.
Marco, can you assist? Marco, are you there?
Yes, sir.
Yes. What are some of the reasons that cause the difference between the bank statement in our cash book, this bank statement balance in our cash book, and I mean the bank balance in our cash book and the balance of the bank in the bank statement?
I think maybe inenge error of omission. Teta omita ime amount patechi isama amount edu ku bank statement neku cash book.
All right. What I want you to know is that in this case, we are talking about two different statements. There is a bank statement and there is a cash book. A cash book is the one that we use when recording the transactions that affect the bank in our records, in our company. Then we have the cash book balance. I mean the bank statement, which is a statement that is prepared by the bank, which is holding our bank account. For example, CBZ, if you are depositing money and withdrawing, you have a bank account with CBZ and then you withdraw and deposit money, what it means is that the bank should prepare a statement of those transactions, showing all those transactions that on such and such a day, you deposited so much. On such and such a day, you withdraw so much. Then you were charged so much. There were deposits from A, B, C, D. Do you understand?
Mm.
So the difference now is that one is a statement that is within our company and we can change it. The other is not within our company. So it is a statement that is being held by the bank. But these two statements, the cash book and the banks and the bank statement should usually be the same if there are no differences. So assuming that what we are doing in our cash book is exactly what the bank is doing, then we expect to see the bank balance in the cash book being equal to the bank balance in the bank statement. Is that clear?
Mm.
But now the difference comes, for instance, if I record in our cash book that I paid $1,000, but the bank, I paid maybe by check, but I give you the check and you go to Mzaraba and you forget to bank the check. What it means is I've already entered that check in the bank statement, in the cash book, bank column. So it has already reduced the balance of the bank in our records. But because we have taken the check to Mzarabani before depositing it, it means that the bank will not account for that because you have not deposited it in the bank. Do you understand?
Yes.
Then number two, we are also likely to have the bank can sometimes charge us interest or pay us interest. But we will not know until we receive the bank statement. So it means that we will not enter the interest in the cash book because we don't know that we have been paid interest or that we have paid interest. So that's one of the reasons. Then we have got situations where we have got transactions that are deposited directly to the bank by our customers. Our customers may decide to deposit cash, to deposit directly to our bank account, and then maybe they have not yet told us that they deposit the money, so we won't know that we have received cash until we see the bank statement. Then there are some payments that we call direct debits. These are maybe things like insurance. Sometimes we pay insurance, and when we pay insurance, so sometimes we can pay maybe insurance which goes directly to debit our bank account, and at that time maybe we don't know yet. So these are some of the reasons. For example, cash deposited by the bank, sorry, by the business, especially towards the end of the month, it happens that sometimes this cash may not have been captured, but it has already been received, and a deposit has already been prepared and entered into the cash book. Then errors may have been made by the bank or business. It's possible that one of us makes an error, either the bank or us. Then check deposits by the business may have been dishonored by the bank, right? Dishonored checks, these are checks that when we try to pay somebody, or when somebody is trying to pay us, but because the account holder who is paying us has no sufficient money, they are dishonored by the bank. Dishonored means that they are not going to be paid by the bank for one or two reasons. Either the account holder has got no sufficient money to pay that amount, or there are some errors. Maybe the words don't match with the what we call this, the words don't match with the figures. Maybe the check is torn or the signatures are not correct. So this is one of the reasons. Then bank charges levied by the bank. It means that if the bank charges us bank charges, we will only see or know about these bank charges when we have got when we have been given the bank statement. So is interest, so is debit orders and stock orders, then direct deposits by customers. So now, we want to know the procedures for doing a bank reconciliation. The procedures performing a bank reconciliation. There are two important procedures. The cash journals of the business must be updated after the bank statement has been received. So what I want you to do is, whenever you want to do a bank reconciliation, you must think of one thing first. You collect your bank statement and you have got your checkbook, your cash book. So what you do is, first you compare entries that are in the cash book with entries that are in the bank statement. So when you are doing the comparison, what you need to do is to tick each and every balance that you see appearing in the cash book and also appearing in the bank statement. So let me give a simple example here. I'll give a simple example. Let me start with I'll start with, oh, I need to change the color. I need to change the color to bring in a more visible color. Right. So, assuming that we have, so this is the bank, and this is the bank in our cash book. So I'll say this is the cash book. So this is the bank. This is our balance in the bank. Assuming that we have got we've got 10,000 in the, okay, let's say 1,000. Then we also have a credit balance here of 1,000. So, like I said, if we have money, our cash book balance will be on the debit side, but our bank balance will be on the credit side. So this is what is there at the beginning of the period. But now we have, say, cash sales of 500. No, somebody pays us by check. Let's say check. And then we deposit that check to the bank. It means that it will come here, 500. Right, colleagues, our time is running out. When it runs out, you must connect with the same link. Okay. Can you hear me?
Yes, sir.
Yes.
Right, I've tried to upgrade. So let's see, we have 9 minutes. So what I'm saying is that we have the bank balance here so far. According to this, the bank balance will be 1,500. And according to the bank statement, the balance will be 1,500. But now, the bank now charges us, bank charge of $50. Now there is a problem because this bank charge, we don't know it yet until we receive the bank statement. So let's assume again that, who is this one? Let me see the names that are there. Let's say Kuda pays us through a check and deposits it directly to the bank, $1,000. So now you can see that if we close these two accounts, this one is 1,500, 1.5, and that's okay, let me use this one. $1,500. This one is 2,500. So 2,500 minus that, this gives us a balance brought down of what? Of 2,450. Then this one gives us a balance brought down of 1,500. Right. So guys, can we see now that according to this, we have our bank balance. So our bank balance here, according to the bank statement, is 2,450. But our bank balance here is what? 1,500. So if we want now to do a bank reconciliation, because a bank reconciliation is now trying to find out what is causing the differences between these two figures, we now, first of all, need to compare the entries that are in the cash book versus the entries that are in the bank. So if you check, it is only this one. So you tick those that are similar. Then the rest, they are not similar, except maybe this one, the opening balance. So we have this and this, these figures, this one and this one. These are the figures that are causing the difference. So if we take account of these figures, then we will be able to sort out the difference. So let's look at the next step, so firstly, before you do this step here, you need to just tick and verify which balances, which entries are the same. Entries that we have entered in the cash book against entries that have been entered in the bank book, bank account. So now, after doing the ticking, what we need to do now, this is the bank. So this bank here, we want to check what is it that is in the bank that we have not entered in the cash book. So we must transfer all transactions, right, that are in the bank account but have not been entered in the cash book, which means that 50 is going to come here because 50 is a charge. So when we enter it in our cash, it's going to reduce the cash book balance. It is a bank charge. So in the bank, it will be debiting. Debiting is reducing in the bank statement. Then this one here is on the credit side, which means it's increasing. And in the cash book, when we are increasing, we must debit. So it must come there. So what we have done, this process, what I've done with the blue is what we call updating the cash book. Updating the cash book. So I have updated the cash book. So the moment I update the cash book, if there are no other differences, the balance should be the same. So you will see that in this case, we are going to say 1,000 plus 500 plus 1,000. It gives us 2,500. Then this side, we have 50. So if we add this, we get 2,500 minus 50. Then it's going to give us, the balance here is going to be exactly the same as this one, 2,450. And at that point, our books, our bank reconciliation is balanced. I'll take questions at this point. Hello?
Hello, sir.
Yes. Hello? I can hear
Am I
you.
audible?
Yes, clear.
Okay. So I
Hello?
wanted to ask Kuti, is it possible that they want it? Is it
Yes, speak. I'm listening.
is it possible that the balances will not balance,
After
like
reconciling,
for the cash book and the bank account?
after reconciling
sir.
or before?
After reconciling?
No, they should balance. Always, the reason why you're doing a bank reconciliation is to make sure that they balance. They
Okay.
should balance, yes. The purpose of
Okay,
balancing,
sir.
the purpose of balancing, okay, this figure here, right, is now agreeing to this figure because we have identified what is causing the difference. Do you understand? Who asked that question? Is it Jezalite?
Jezalite.
Mm.
Yeah.
Right. Jezalite. What I'm saying is that you want to show us why we are having the difference. Do you hear what I'm saying?
Mhm.
All right. So in this case, it is balanced because